Hi, Elizabeth. How are you today?
I'm great. How are you, Dahlia?
I'm excellent. Thank you. I'm so excited to have you here today on our Adapt and Thrive episode. You are a veteran investor, you are an award winning investment coach, and I'm so happy you're able to join us. For those who don't know you, let's do a quick introduction and then we'll get right into the questions.
Sure. Thank you so much, Dahlia, for having me. I've been an investor for almost 20 years. My husband and I started our companies I don't even want to say how long ago that was. And we've invested in apartment buildings. We've done a lot of rent to owns. We did some BRRRRs before they were called BRRRRs. We've done some wholesaling, and we've seen a lot of changes happen over the last almost 20 years. We rode out the recession in 2008, which was always an adventure. And now I was a trainer for Rich Dad for 8 years. And several years ago, I opened my doors to be a coach and consultant for beginner and intermediate level real estate investors to help them figure out what the next steps in their journey would be. And this is a really unique time. It's a really great time to be a coach and an investor because everybody's done so well the last few years, and now I think it's time to talk about, where does the rubber meet the road, and how do we adapt as real estate investors? And like you said, how do we figure out, what are the things we need to do in order to thrive given this new environment that we're in?
Absolutely. And I've heard you speak. I have met many of your clients who you coached and helped grow. And what I love about your approach is that you manage risk. And it's not about, you know, here is the flavor of the day investment strategy to jump in and like let's just make money. It's all about suitability of the investment, the market, the research, managing risk. So that's something I adore about your teaching style and coaching style. Like you said, the environment is changing, and we all know that the interest rates have gone up, and there is another expected increase in September. And for investors who have been on adjustable rate mortgages that go up as the Bank of Canada raises prime, some have seen their cash flows decline, an erosion or a decline in their cash flow. What are some of the strategies that you're currently deploying personally or recommending to your students to address the impact of declining cash flows?
Well, we do a really deep dive, and I don't just do it with clients. I do have people who come to me as a consultant to look at their portfolio as well. Overall, what I like to do is figure out sort of what is the long-term plan. And if the long-term plan is wealth building, then it makes sense to take a look at the portfolio and to figure out where we can optimize. Where can we shift from a long-term rental to a short-term rental to beef up that cash flow in order to support maybe not just one negative property, but if you can get your income high enough, can we support a couple of negative cash flowing properties? If the goal behind the portfolio has really been cash flow, then a negative cash flow obviously is a much more serious thing if you're not working and you were counting on that cash flow to live. So at that point, we start looking at alternative strategies. Is it possible to take an existing property and bring in a joint venture partner in order to be able to assist with providing a little bit of a cash injection to be able to ride out the tough times? In my time as an investor, I believe that the situations we see like this, they are relatively short-lived. At some point, real estate will turn around and will start to go up again. So the question isn't so much like, oh my gosh, my portfolio is negatively cash flowing. What do I do? Let's have a fire sale. It's
Mhm.
really, how much am I negatively cash flowing? What can I do to reposition my portfolio, whether it's letting go of something that is really underperforming, whether it's, looking at somewhere else where we can generate alternative streams of income, maybe create a new stream of income, or whether it's, okay, I anticipate I can weather out negative cash flow for the next 18 months based on, these are the reserve funds that I have. And it's really about, I think, having a really clear understanding of what is our goal, and then what is the best way in order to achieve that. I don't believe in having fire sales and getting rid of properties that are negative cash flowing in the short term in order and jeopardizing our ability for the long-term wealth unless that puts you in a bad situation financially. But I think it is important to be realistic and to know your numbers. And I think that's one of the fundamentals. And that's what I love about you, Dahlia, is that you're such a big advocate for know your numbers. And I know that there have been clients where they've had, tricky portfolios and we've been in certain circumstances and I've come to you and, we've sat down together with clients and said, okay, let's look at this. Let's put our heads together. Let's figure out how we're going to help you ride this out, whether it's, replacing a high interest mortgage over here, whether it's, deciding to liquidate a key property over here. And basically we just kind of look at that. Everybody's situation is unique. That's one of the best things about real estate, but that's also what makes it one of the most challenging is that people get bits and pieces of information from, all over the place, and then they can't figure out how to put it together into a puzzle that makes sense for them.
Yeah, yeah, very, very true. And I love that you addressed things that the client can think about on the strategy side, on the income side. We focus on the debt management side and how there may be sometimes opportunities to restructure to help improve also cash flow. So that could be extending an amortization, or it could be clearing expensive debt with cheaper debt, or it could be converting principal and interest payments to interest-only payments temporarily, so it makes it a little bit lighter on the pocket, things like that. But I think the power comes when both the advisor and the mortgage broker talk together to look at the top line and the bottom line to help address the cash flow, any cash flow challenges. So thank you for that.
You're welcome. I think it's equally important to address boosting income and reducing expenses. I agree with you definitely on that point, Dahlia.
Yeah. Are you seeing your investors sit on the sidelines right now, Elizabeth, waiting for the prices to hit rock bottom, or are they still shopping and negotiating deals? And if they're shopping, what strategies are they considering right now?
So that's a great question. So there's two things happening. It depends on the strategy. So definitely my clients who are primarily flippers, primarily burrs, those kinds of strategies, they're definitely not shopping for those types of properties. But one of the things I'm a really big advocate for my clients is don't limit yourself to one strategy to define yourself. Become a holistic, like a well-educated real estate investor, so that it's more about, I found a property. What is the highest and best use of this? How can I maximize my returns from this property? It's not that I have to find a property where the numbers work for a burr, because sometimes there are opportunities that present themselves that don't make sense for a burr, but
Mhm.
maybe they make sense for a garden suite, or maybe they make sense for, a short-term rental because it's one of the few markets, one of the markets that are left that still allow them.
Right.
So I think it's really important to be able to recognize opportunity, and that's what my clients are much more focused on right now. Yes, we know that the numbers are probably going to continue to decline. I'm estimating early 2023 before we sort of start to see the downward slide. Looking at turning around. I think there's still going to be a number of people in the fall, particularly homeowners who, their mortgage payments have doubled in the last, year or so. I think
Mhm.
those people are some of them will become distressed and will need to sell, and that we will definitely see some opportunities. I've been talking to my clients a lot the last little while about repositioning portfolios, getting access to cash, and being ready to take advantage of opportunities as they arise. I think if you are focused on finding deals and finding opportunities, then any time is a good time to buy. But what I think what we have done is become a little more conscious of risk. So we're not just assuming that you can refinance for, 30% more than you bought the property for. Now we're backing down and we're saying, okay, if we buy the property now for 700, in 6 months, it's only going to be worth, if it's worth 650 or 625, do we still make money in this particular deal? And if the answer is yes, then we believe we've mitigated the risk um, around what the market's doing, and the investment still makes sense.
Okay, so what I'm hearing is that they're still crunching numbers, they're still looking at deals, and if the deals still make sense, despite the fact that there may be still softening in values, they would still invest because it is a long-term play after all, if the numbers make sense, and focusing on being more diligent about risk these days, even more than before.
Yep, and definitely the focus on cash flow. You know, anytime I work with clients, I'm always like, okay, what's your exit strategy? And they give me one. I say, okay, what's your next one? What's your plan C? What's your plan D? Like anytime I look at a deal, I want to have four different options available to me. And right now it's a riskier time to do the shorter term strategies like burrs and flips. It
Mhm.
makes a lot more sense to look at it. And I was looking at a deal this morning. I had someone who approached me and they said, would you consider doing a flip on this? And I looked at it, I said, I'm not confident that I could sell this in 6 or 9 months for, what I would need to get out of it. I said, but if I look at this as a 5-year hold, let's look at the historical data on the market here. Let's build in some room for, market risk. And then if I look at that, if those numbers make sense, then I'm still moving forward with deals. I'm not saying no, I'm just adding more risk in. I'm building myself a wider buffer or margin for error to accommodate the market risk.
Okay, fantastic. My next question was going to be, what are you and your students doing right now to prepare for the opportunities ahead and to manage risk? And I think you've answered that question partially. You're welcome to add to it. But what I heard you say is accommodate, plan for higher margins of error. Flips are not necessarily the way to go right now, but also line up cash. Can you tell us a little bit more about what you meant by lining up cash?
Well, the fundamentals in Canada are still present. So we are still seeing that there is not enough housing for the number of Canadians who are here right now, let alone the number of Canadians who will be here next year and the year after and the year after that. So I think it's important to be sort of looking at the overall trends. And I believe one of the things that I'm doing with a lot of my clients is we're pivoting more to look at land development. We're looking at opportunities, to take either, land or vacant buildings. How do we turn them into housing? Because the demand will be there. We know it's going to be there for decades because we don't have enough housing as it is. So I really believe that I try and stay away from some of the mainstream media, kind of the fear stuff, because I feel like it puts us into a scarcity position. And I feel like there's a lot more room for abundance and opportunity there than most people are sort of experiencing right now. So I think it's important to look at the longer term play because really that's what real estate is. It's not about timing the market. It's not about, okay, well, the market's going up, so I better sell now, or the market's going down, so I better sell now. It's really about, what do I want my position to be in 10 years, in 20 years, in 30 years? And if you look at the historical trends, it's upwards across the board in real estate, but there are times where it goes down and then it grows again. So it's important, I think, to look at that long range plan. And to me, land development, some of the new builds and those kinds of things where we're actually creating housing supply, that's the only way we're going to be able to address any of the housing shortages that we're seeing. And the demand will always be there for those, especially quality units.
Interesting. Okay. And on the point of raising cash, are you talking about tapping into equity through secured line of credit so that when opportunities come, clients are able to move faster? Or are you referring to things including that plus joint venture partners plus private money? Can you elaborate a little bit more about lining up?
Well, this is where I always like to defer to your expertise because I don't like over leverage. So I know there's a lot of like prom notes going on out there, unsecured loans. Those make me nervous. I know that there are people who, have their portfolios and, they're, 95 or 100% loan to value on, the value of the buildings. All those things make me nervous for my clients. And the reason why is I believe you have to have been an investor who's ridden out a downturn to be able to fully understand and appreciate the risk you're taking when you use strategies like that.
Mhm.
So in terms of, pulling equity out of a property, if you're at 40 or 50% loan to value, then yeah, go ahead, take some money out in terms of a line of credit and, use that to secure future opportunities. But I don't believe in, the 90 and 100% loan to value because you see a market like this and you become a motivated seller.
Yeah.
If it was a property that you needed to liquidate because it was negatively cash flowing, now you are a motivated seller and you're going to have to put money in to close. And I never want to see an investor in that position. And I saw a ton of it in 2008, where investors were literally like losing everything they had.
Yeah, I can't agree more with you on this particular point of really being very, very careful about high leverage, private money, and promissory notes, especially in this market that we're heading in. Just in the past 2 weeks, I've seen clients in the exact situation you've described. They're coming in where the values have softened, the amount of debt is larger than the value, and now we are dealing with a shortage. It's because of that very high leverage, which typically works in an upcycle where the values are going up, 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 up. But now we are in a flatter market, and that's a different environment altogether. So I hear you there.
Yeah, it's the environment we've been in the last few years, I think, has lulled people into a false sense of security and has made people believe that, anybody can make money in real estate. And I think it's downturns like this that really show the people who have, thoughtfully and carefully planned their growth and their portfolio. I mean, I saw an article this morning of another developer in London who has just gone under and won't be building, all the pre-construction stuff. I think there's definitely ways that we can mitigate risk in real estate. And I think one of the things that's the most important is not to get fixated on the number of deals or how much we're doing, but to actually pay attention to, what is my risk tolerance and what can and should I be doing to mitigate risk as much as possible to help ensure the growth that I would like to see.
Yes, yes. The risk appetite is key into any conversation, whether it's the debt side of the business or the strategy side of building a portfolio. That is fundamental to everything, I find. The
Totally
last
agree.
question, the last question, Elizabeth, is what is the most important thing investors should be doing right now, in your view, given the shifting environment?
Well, so there's a couple of things. So the first thing I always tell people is we need to know what your position is like right now. So we need to know what the numbers are for your portfolio. We need to know what the true values are. We need to take a really honest look at where you're at. Because if we can't have that honest look, if we're so busy, looking at things through rose-colored glasses and assuming we're making money and not actually looking at the bank account, then we can't figure out a true plan that's going to help us. So we need to figure out where we are right now. If we already have deals, how do they look? What kind of cash flow are we generating? What kind of returns are we getting? The second thing is to think about where we want to be in the future. And then the third step is to chart that, what does that dotted line look like from where we are to where we want to be? And then it's figuring out, I'm a huge believer in education. I invested a ton and I continue to do so in my personal development and my education around real estate. But I think it's important. This is where we need to be super informed about the decisions we're making. I'm still seeing investors out there who are putting in offers and then going and trying to get financing after that. There's definitely a formula and a process that we can follow to, set ourselves up for success. And I believe that, things like that, get pre-approved, not pre-approved, but talk to a mortgage broker like yourself to get approved or to get an idea of what that approval would look like. Make sure you're running numbers with the true numbers. I mean, there's no point running numbers with a mortgage at 3.5% if you can't get a mortgage at 3.5%. So gather your information, gather your team of professionals around you to support you in your growth. Make sure that you're prepared and then jump out of the nest, and don't try and jump out of the nest beforehand.
I love that. I love that. And on that point, this is a market where extra diligence, in my view, is also needed. So put in your financing condition or appraisal condition in particular, because gone are the days where someone would put an offer and a week later the property is worth more, or 2 weeks later it's worth even more. There are chances now where you put an offer and the value may be short, so you got to protect yourself. So this is a time for extra diligence and go back to conditions to protect yourself as well. So I just wanted to add to your suggestions there as well.
Yeah, this is a market where speed matters. So the more preparation you do before you put in the offer, the more you know what your financing position is. You know and understand the numbers for your deal. You're confident in whatever strategy you're deploying, and you can close faster. All those things are going to help you make better investment decisions because this is a time where if your closing is 90 or 120 days out, there's pretty good likelihood your property is going to be worth less than it was when you offered on it.
Yeah, yeah. Agreed. Thank you so much for the tips and insights you shared with us today. Where can our listeners find you if they have questions?
You can find me really easily online. I'm on Instagram, Elizabeth Kelly Consulting. You can find me on Facebook, Elizabeth Kelly Consulting and Coaching. I promise I'm around. I also have a YouTube channel if you'd like to check out because I have some great informational webinars that I've done over the last 3 years, and you've been a guest on some of them too, which I really appreciate. So tons of information and value there. And if you're wondering, how can you work with your portfolio? How can you turn it around? I love having those conversations where we'll dive deep and figure out how to maximize your cash flow.
Fantastic. Thank you so, so much, Elizabeth. Thank you.
It's my pleasure always. Thank you so much, Dahlia. Have a great rest of your summer.
You too.